Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to try and get you guys what you need to know before you go. So let's get on with it. Starting off with some economic data, build into talking about the markets, and then we'll talk about some option strategies we could implement into our portfolios going forward. All right. So without further ado, let's get on with it. Economic data across the pond. Really not a whole lot to see there, other than we did get some PMIs, purchasing managers indexes. Now that's one of the gauges that I like to look at. Why? Because it's forward looking. You got to think about these folks that are purchasing managers. Well, they're running the operation of their corporation or whatever they're in, and they purchase different supplies for the manufacturing process, right? So when they see a lot of demand, they're buying a lot of little ancillary things for that manufacturing process. Something to note with this number, anything above 50 is expansion, anything below 50 is contraction. Well, Spanish, everybody pretty much came in above 50. As a matter of fact, everybody pretty much came in line with expectations or a slight beat there. We might have seen a little bit of a miss there with French manufacturing, French and Germany being the biggest manufacturing sectors of the European region. So we're going to be looking a little bit more focused on them. Even Great Britain came out with better than expected purchasing managers index numbers there. I thought I saw maybe China waned a little bit. Yeah, but still above probably the best number there. All right, so let's move on with us here in the United States. We've got our own ISM, which is the Institute for Supply Management, expecting to see that number come in at 58. So anything better is going to be a push to the upside. Something to really note with those numbers is we do get a prices paid component. That is going to be something really that we will focus on going forward, because we're going to be ultra concerned about those interest rates. And that is going to be moving based on what we see with these numbers here on inflationary pressures. All right, so without further ado, let's get on with the charts here. We've got crude oil making another move solidly into 100 now. Yes, 100 means about $4 a barrel, $4 a gallon at the pump for the most part. Now you're starting to see a lot of folks talk right now about this oil price and how it is a tax on the middle class. Now, you won't really hear our government talk like that, because they don't like that kind of news, if you will, because what happens is they say that it's a supply demand thing where we are all driving, we're wanting to go back to work, and we need to have that gas in our car. Well, that drives demand. Well, the manufacturing sector does drive some of that demand as well. As a matter of fact, probably more so. But the thing that hurts the most is we have to drill down on this. Folks are living on budgets for the most part. It doesn't matter really what your income stream is. Those folks are having a budget, even if they're making a lot of money, because they're spending a lot, I guess. At the end of the day, those folks, when we're looking at budgets, if you're spending an extra $10, $15 a week, or even a couple of days for filling up your gas tank, well, that eats into what you could buy elsewhere. And if you can't buy an extra Coke, or you can't buy, Starbucks, you can't go to the movies because you're putting money in your gas tank a lot. Well, that means that money's not really getting into the system, and it's not creating velocity money, which helps with the economy. So this is a tax on the middle class. There's no way around it. It will slow. It will cause the economy to slow a little bit. So I don't know that they're going to probably really push too hard to get that oil price back down. Yeah, they're saying they're going to release reserves and stuff like that. But at the end of the day, they've got other fish to fry, it seems like right now. All right, bonds moving higher now. This is a little bit more unexpected than what I was thinking here. Thought we had paused here in and around the point of control. I was not expecting us to look to go back and test the 160 handle. Now, I didn't think that was in the realm of possibilities these days, but the market is coming out and saying that what is going on in Russia is going to cause a global slowdown. So rising interest rates is probably not going to, it's going to be very difficult, folks. And I talked about this back in the day when I was on the floor and doing interviews, and we've started talking about helicopter money and all of that stuff, that we would get to a point where we could see stagflation. And it wasn't that we could see it right away just on the first couple of bouts of this, quantitative easing and things, but the printing of that money, and we get used to it, we get onto that Kool-Aid, it has a tendency to seep back in. So are we going to start seeing stagflation where folks, we're seeing inflation because there's so many dollars moving around the system, and then everybody is kind of like on a wait and see? I mean, folks are struggling coming out of this pandemic. All right, they're used to working at home. They're used to being isolated. They're having trouble entering the society, folks. It's a real thing here in and around the United States, and probably the world for that matter. So keep that in mind, that could really also exacerbate some of this pain that we're feeling here in the economy, as people don't want to get out of the house or would rather work from home. Well, those work from homes, as great as it was for all of us, that doesn't really stir the economy, to be honest. All right. Gold, we're going to see 2000 again, or not again for the first time, but I do think that the market is going to continue to trudge up that way, as folks are going to be rolling out of some stocks. They're going to be rolling out of some of these high flyers, folks, like the NASDAQ. I think the NASDAQ has had its correction. I don't think that there's much more downside really for the NASDAQ. I think that it's felt the pain already. But I think as folks are going to be continuously concerned about what's going on in the Ukraine, what China's doing on the edge of Taiwan there, well, I think people are going to fly to safety here, and gold is going to at least remain in the 1900s for the foreseeable future, probably going into the summer here. So with gold, I would say the risk is still to the upside there as well. And I think Bitcoin has a lot of room to catch up with that. I think that we're going to also see some of these alternative assets start to make some moves here in the next couple of years, or especially in this year, because of the turmoil we're seeing globally, and with the, pricing of way stocks have been. Folks are a little bit worried that they're buying high at this point. So I think they're going to be looking for opportunities in markets, so we can see a little bit more chop. And some of those opportunities overall are going to be in, I think, things like crypto. So Bitcoin making its move to the upside. And obviously, I think I did my charts a little bit wanky here. We got the VIX moving higher as well, but that's not a real surprise, as we're seeing the equities have that chop we were talking about. Now, NASDAQ, we can see the measured move not even getting close to above the 50-day simple moving average, which I'm not really surprised about. It's had the move. It's drawn the market up as we've gone, and we're seeing lower highs. Risk to the downside here in equities. And we would say that normally when I get a candle like that at the top of a move, I'd be very interested, something like this, but it's inside, so I'm going to stay away from it. I do think that folks, there is more risk to the downside in things like the NASDAQ and in tech sector rather than here in the blue chip land here in the Dow Jones. I think Dow Jones has had a correction here. Yeah, well, but I do think that it will have less downside than something like the NASDAQ going forward. And I'm not really expecting to see major corrections here. I'm just seeing more chop here as the uncertainty kind of unfolds, which is going to drive folks over into gold, Bitcoin, and things like that, where you're going to see more of a retainer of value there. All right. But most of the equity is starting to look like they want to roll over. I don't think there's a significant downside here anytime probably this week anyway, for that matter. And we've got the mini S&P right at the point of control. Yes, we're in negative territory. Folks are going to be talking about that. But hey, guys, this is where we've all been seeing this market transact. It's not very interesting when you see the E-mini S&P is trading 4,444 or something like that, or 4,400. That number has been beaten like a dead horse. So I don't think people are going to really be too interested in trying to capture that price. Hey, I was able to buy the E-mini S&P at 4,300. No, that's not a number people are going to really be, touting. They're going to be talking about numbers when they catch a nice sell-off, this really being at a point of control. Everybody's transacted or had on their card 4,300 at some point in time when they've been trading. So that's what these levers and pulleys are in the markets, and they come back to this psychology that I talk about so much. If you've seen those prices transacted a lot on your cards, you just don't have any real incentive to trade them going forward because you knew it didn't go anywhere in the past. It's probably not going to be a significant price going forward there. All right, and the breakdown, you can see just a nice little drive this week, moving higher here. It is a grind here. Risk still to the downside, folks. I would probably be looking more at doing some covered calls on any of these major pops. We've got high volatility that allows you to get further away from where the underlying is trading right now. The other thing is if you're thinking about building a portfolio or building a portfolio out, you're starting to wonder, hey, we've had this correction. Now is it time to start adding to our portfolio, or should I be buying right now? In my opinion, well, yes and no. I think you should be selling some puts. And I talk about strike location, about all of those types of strategies in my webinar. So please check those out in YouTube. You can just search for them, really, to be quite honest. It's pretty easy. And before you go, make sure you smash that like button for me. It looks like somebody already hit it up. And make sure you guys are subscribing, because I'm not really on a set schedule for these spotting the trade. So if you want to participate in those, make sure you got the little bell right next to the subscribe button fired up. And don't forget to comment if you have any questions, because I will even circle back around to make sure everybody's clear of concept. So can't take that. Take it easy.